Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Ira Harris and Dr. Lacy Hunt. Ira is an independent trader, successful hedge fund manager, global macro consultant, trading foreign currencies, bonds, commodities, and equities for over 40 years. He was also CME director from 1997 to 2003 and is currently also now CME director there. And Dr. Hunt is economist and executive vice president of Hoisington Investment Management Company. He is vice chairman of HIMCO's Strategic Investment Policy. He's authored 2 books, A Time to Be Rich in Dynamics of Forecasting, Financial Cycles, Theory and Techniques, and has had articles published in Barron's, The Wall Street Journal, New York Times, the Journal of Finance, Financial Analyst Journal, Journal of Portfolio Management, and other media. Welcome, gentlemen.
Great. Nice to be with you, Richard.
Great, thank you very much. And just thought we'd begin the discussion with all the turmoil going on this week in the markets, in the financial markets, all across asset-wide. Just your thoughts. Why is this happening? Is this all due to the coronavirus? Yeah, we just thought we can begin. Dr. Hunt, your thoughts?
Well, as we came into this year, our view was that we would see weaker economic growth, slower inflation, and lower long-term bond yields. And we based that on several arguments, some cyclical, some secular. The first argument was that the domestic and global economy is experiencing a massive debt overhang. We have too much debt, too much of the wrong type of debt. It's triggering the law of diminishing returns, which is making economic activity weaker, not stronger. And that the general approach remains to try to solve an indebtedness problem by taking on more debt, and we're getting counterproductive results. Second consideration that led us to this conclusion is that we felt that there was a considerable deterioration in global economic growth in 2019. The key metric that we're looking at there is the volume of world trade. Declined 0.6% last year, which was only the third decline since 1980, and the other 2 were in the very deep recessions of 1982 and 2009. Historically, world trade growth is normally 5%, or that's the rate it's been since 1980. And global GDP growth has been about 2 3/4. Trade has typically lifted the economy. Moreover, trade typically does not turn down until you're already in a recession, which suggests that we were very vulnerable and very frail. Third consideration that we were looking at is that in spite of the 3 cuts in the federal funds rate last year and a $300 billion increase in the Fed's balance sheet and an acceleration in M2 growth, that the thrust of monetary policy was still restrictive. There were very, very long lags here. And the 2-year increase in the money supply last year was declining about 4% versus the long-term historic average rate of growth of 7%. There was also a sharp slowdown in bank lending growth. And most importantly, we've been experiencing a declining trend in velocity, and we've had declines in velocity for 5 consecutive quarters, which means that the actions taken by the Federal Reserve have been trapped in the financial markets. They have not moved into the global economy, and that this process has been occurring in Europe, Japan, and China. Money growth came down in all three of those areas. In the United States, velocity is about 1.42, but money did not turn over one time per year in Europe and only about a half a time per year in Japan and China. Another consideration that pointed to weaker growth, inflation, and lower bond yields is that corporate profits have been stagnating for a considerable period of time. In fact, since second quarter of 2014, profits have dropped about 4%. Our view is the stock market is not a good leading indicator. It's a worthless leading indicator, actually. And although there is a theoretical possibility of a wealth effect, it cannot be measured to any significant degree. That's the finding of the Nobel laureate at Yale University, Schiller. Additional argument that we made is that there was a considerable increase in excess capacity and the output gap in the United States and globally. And finally, we feel that one of the conditions that's been retarding growth for a number of years now is very weak demographics. U.S. global population last year was slowest in about 80 years. In the United States, our population only increased about 0.5% per annum, which was the lowest since 1919, which was also the year of the avian flu virus, kind of ironic. But in Europe, population growth is only 0.2%, slightly negative in China, and negative 0.4% in Japan. And it's very difficult on a consistent basis to overcome those type of negative demographics. Now, I don't have any knowledge of viruses and whether they can be contained or how long they'll last, but the only perspective that I would add is that once and if this is contained, we will have a very difficult recovery. There will be a recovery, but it will not be V-shaped. The major economies of the world are just too fragile with too many problems. And there's a lot of evidence to support that. Between Europe and Japan, there have been 5 recessions since 2009. 3 in Japan, 2 in Europe. In each of those cases, the recessions were said to be due to transitory factors, and the overwhelming consensus was that the recoveries would be V-shaped. None of them were V-shaped. The Chinese have a miraculous talent of putting monthly numbers out that beat the consensus or meet the consensus 80% of the time. But even with this miraculous track record, Chinese economic growth last year was at a 29-year low, and it was probably maybe only half of what the Chinese said it was. And the Chinese are more indebted than any major country in the world with the exception of Japan. They're in a very vulnerable situation, and they're throwing more debt at the problem of dealing with the virus, which will only further push them out the diminishing returns curve. And so there was a strong fundamental case for weaker economic activity, which we believe is unfolding. And now, of course, we have the negative consequences of this virus. So that's basically our view.
Mm-hmm. And your thoughts, Ira?
Well, I mean, it's very interesting to listen to it, and I look in, and from a trader and investment standpoint, to look at that excess capacity that exists around the world, and I think too many people are talking about a supply shock, and I keep thinking that what we're going to wind up with is a demand shock, because people are really going to retrench. Number one, I I always like to listen to Dr. Hunt talk about debt because I think debt is every problem begins with debt. When I say every problem, not every crisis really begins with debt. And in a world with excess capacity, when you get slowing demand, whether it's forced because of the change in people's behavior, whether it's demographic, whether it's just merely a return to the basics of Austrian economics and capitalism, which is, hey, everybody gets geared up, everybody starts, creating all this capacity, and then you have a downturn in the business cycle, which foments the need to raise cash, which pushes product out. And I really think that and I thought this, since the beginning of the what do we call it, the COVID-19 crisis, that we were going to run into a demand shock because people are going to get nervous, who stop traveling. And you know what? Not everything can be done over the internet, and it was not all going to be picked up. And I think that's what we're facing here. Now, I've been wrong in my trade. Well, I've been right on my trading, but wrong in my longer-term picture because I was looking to keep my investment short, much more, to 2 years or less. So I'm missing out on some of this, of course, this appreciation on the longer end of the curve. But I still think that there's way, way, way too much debt out there, both private and public, and that it will come back to haunt, and that, as we're going to see, the central banks are going to panic yet again because they react to financial situations only. And here they had an economic situation that I believe the Fed made a mistake by not embarking upon some type of emergency measures and stating in a very direct purpose why it was doing what it was doing, and if the results of the potential pandemic didn't bear out, that they would rescind a rate cut. It would be a more significant rate cut, 50 basis points minimum. But you know what? They wanted to hold firm. So be it. But I still think that they're going to have to find a way to steepen these curves, because these curves keep doing what they're doing. I think they're really going to be in a very, very difficult situation.
I'd also like to echo what Ira said. I thought your analysis was quite excellent. I think one of the things that the central banks are not willing to recognize, but are nevertheless a factual expression of the way the world exists. The capabilities of monetary policy now are decidedly asymmetric. When the Fed tightens, they can slow things down. And in fact, their ability to slow things down has been somewhat enhanced because we're over indebted, and this causes a decline in the velocity of money. But because of the over indebtedness and the declining velocity of money and the fact that we're so close to the zero bound, monetary policy is almost impotent. They can take actions, and they will take actions, but I don't believe that it will have much of an impact. In fact, I'd like to recommend that everybody look into the work of the late Stanford economist Ronald McKinnon. McKinnon, unfortunately, had an accident and died in 2014. He was one of our best thinkers. And using general equilibrium analysis rather than partial equilibrium analysis, McKinnon made the point that as the interest rates come down towards zero, even before they reach zero, there's a reversal point in which the lower interest rates have net counterproductive effects rather than productive. This is a little bit hard for practical people to sort of understand, because they think that if they were paying 4% for money and they are now only paying 1% or 0.5% or whatever, that folks will borrow more. And that's true, but when the government rates and the very high credit rates come down, particularly the government rates, the governments are incentivized to borrow more, which then triggers diminishing returns, makes the economy weaker. In addition, because physical investment must equal saving out of income is comprised of private saving, government saving, net foreign. So when the government then steps in, presumably to come to the rescue, the government is saving then eradicates the private saving, and there are no funds for physical investment. So that's a major counterproductive effect. And another counterproductive effect is that when the rates get this low and the curve gets this flat, it eviscerates the profitability of the banks and the other financial institutions. And so while the Fed can take action, and they will take action, as Ira said, the results are going to disappoint a lot of folks, in my view. And they may be entirely counterproductive.
Mm-hmm. And what about on the fiscal side? What are your views on fiscal or debt finance fiscal policy spending as being potentially equally ineffective?
It's totally ineffective. If you do a little test, and if you just plot the gross government debt to GDP, which is the preferred measure based on the arguments made by Ken Rogoff at Harvard, versus the long government yield, you'll see that there's an inverse correlation, which of course confuses a lot of folks. How many times have we heard predictions from people that the large government budget deficits would lead to faster growth, inflation, and higher interest rates? Well, government debt is at an all-time record of GDP. When I was in graduate school back in the 60s, the standard view was that $1 of deficit spending, debt financed, would stimulate GDP by $4. In other words, there was a multiplier of $4. And today, the best evidence is that the multiplier is minus 0.1. In other words, if you get $1 of debt financed increase in government spending, you're going to reduce private spending by $1.10, and you leave GDP weaker at the end of 3 years. And if you recall, we had a $2 trillion stimulus package in 2009, and the benefit there was a couple of quarters. We had written in our letter that we felt that the tax cut that took effect in January of 2018 would lift the growth rate for 1 to 2 quarters. Now keep in mind that the tax cut was a $3 trillion debt finance program over 10 years. And then there was a bipartisan, I emphasize the word bipartisan, increase in spending that added another $3 trillion worth of debt. And if you look at aggregate hours worked, before this big surge in early 18, aggregate hours were growing 2.3%. And the peak after the tax cut and the spending increase was to push it to 2.4, and now it's at 0.9. And that's going to be revised downward because the source data for the labor markets, the quarterly survey of the quarterly census of employment wages through September is showing the job count is 347,000 overstated. So we undertook it, captured the imagination of the equity markets, and for a time adversely affected the bond market. but the fact is that there was no net benefit. And so at this stage of the game, monetary policy and fiscal policy monetary policy is asymmetric, and fiscal policy will not work if it involves debt-financed activities. I think actually we could probably improve economic growth if we were to rein in the government deficit, but no one believes that, and the public wouldn't stand for it, so it's not likely to be the case. But the outstanding work of the McKinsey Research Institute, which is the research arm of McKinsey and Associates, they looked at these 24 advanced economies that became extremely over-indebted in the time period from 1900 to 2008, and they found in all 24 cases the only way out was a period of what McKinsey defined as austerity, and austerity was explained to be a sustained multi-year rise in the saving rate. You're not going to solve an indebtedness problem by taking on more debt. You're going to get worse results. Mm-hmm. And I think that's consistent with the latest econometric evidence, and also some of the best of the theoretical work by some outstanding people, including the late Ronald McKinnon.
Yes, exactly. And your thoughts, Ira?
Well, it's wow, it's a lot there, and it takes me back to when Olivier Blanchard wrote that piece about the multiplier effect. I think the most recent work that he put out was 1.6 on public sector fiscal stimulus, and that kind of died quick on the vine too. Nobody even ran with it. I read it, and I read it like, wow, it is far different numbers than you see. So that has certainly been pushed back. And you know what? When Dr. Hunt talks, the Germans' hearts go pitter-patter because, you know, they're the ones being put upon that they've got it all wrong, that you need to open up those spigots and spend. In fact, I thought the news out yesterday and today from Lagarde, and again, she's not a dove, she's not a hawk, she's an owl by her own definition. And she knows that the bank moving here makes no difference. So I thought she was really smart to absolutely deflect that, because if the ECB were to do anything, it would remove again any real movement to changing some of the spending patterns that could be changed somewhat in Europe. So she's really smart to get away from, well, when in doubt, just cut rates, because you got to be seen to be doing something. And I was really happy to see her walk that back, because for Europe, that would not make one. I think that Dr. Hunt is right. It'll just make things worse and worse, because the banks aren't lending. If the banks, I always return to the work of Joseph Schumpeter. We can go back and read his essays during the Depression, when he was, really prolifically writing and talking about this, and the concept of pushing on a string, and that, hey, you can keep cutting rates, but if you can't effectuate a real return on money, nobody's going to borrow anyway. And people aren't going to take on debt just to take on debt unless you're in trouble. So, and those people aren't doing anything positive. They're merely looking to sustain their present situation, and outside of some type of forbearance, it just complicates the matter, and actually is I think, as Dr. Hunt rightly talks, is a drag going forward. You can keep, as Bernard Connolly and I've discussed for so long, about intertemporal disequilibrium, and you can keep bringing things forward, especially as we can in a credit-based system. But eventually, you run out of the future, because you've brought all the future forward. And I'm not sure that we're not very close to that situation now, that you've borrowed all you can from the future, and everybody's trying to just figure out where in fact they're at here. And it's why, for so many people, there's no capital expenditure. Because if I'm running a corporation, why am I going to do any real capital investment with all this uncertainty? And if I really believe that I've brought all this demand forward, I certainly don't want to take on any new large capital spending program. So I think, everything that Dr. Hunt talked about is just dead right on target.
Mm-hmm.
I really like your terminology, Ira. Of course, we have the econometric evidence, but we also have some research done by some outstanding humans of earlier ages. And one of the first systematic investigations of public finance was done by David Hume in 1752. Hume, of course, my professor said that the Enlightenment could not have happened without David Hume. Hume, in his treatise on human nature, discusses a wide variety of things, including time and space, which Einstein himself said gave him the inspiration for the theory of relativity. And Hume had mentored Smith, and Smith said of Hume that he was our greatest intellect. And Hume was in a position to know because he knew all the other figures of the Enlightenment, including Ben Franklin, as well as the French philosopher Voltaire. In 1752, Hume writes an essay, which anyone can obtain on the internet, called Of Public Finance. And he looks at all of these cases of empires, large and small, that become extremely over-indebted. And he looks at two of the historical cases that were available at the time, Mesopotamia and Rome, and then a lot of lesser cases that no one remembers. And toward the end of his essay, which everyone should read, he says, and here's his language, is fairly close as I can remember it, when a state barred against all its future revenues, and that's the point Ira was just making, when a state has barred against all of its future revenues, the state by necessity lapse into tranquility, languor, and impotence. David Hume, 1752, one of the great minds of mankind.
Wow.
And I know from reading Dr. Hunt's work for all these years, I know where he goes with it. And listen, it's an honor for me to even sit here and discuss it, but so much of that, and when, I'm a markets person. So it's not only, as I talk about the praxis of taking the theoretical and making it practical and applying it so that you can actually put it to use in seeking better returns, if not at least a return of your capital. But this is the stuff that is really great. I mean, I've been lucky to have studied under people who introduced me to, especially Fernand Braudel and his study of the Mediterranean economies, and Philip, II of Spain. And these things have applicability to today, but everybody wants to forget about them because, again, if you're not running a 7-year algorithm, you're nowhere in today's world. But I love that Dr. Hunt brings this up because it does. It is so applicable. And I've been dusting off all these books. In fact, I just read along the 21st Century by Giovanni Arrighi, which is out of the Braudel School, which was just phenomenal. And studying, we've been here. This is not new. I don't want to say that
one of the more recent things that people can read is the Ascent of Money.
Yes.
Which
yes.
I'm having a senior moment. Neil Ferguson.
Yeah, Neil Ferguson's book, right?
Neil Ferguson. You can read Ferguson, which is. By the way, if you don't want to read the book, you can find the series he did for PBS, which he himself narrated. I mean, you can get it easily. You can also read Manias, Panics, and Crashes by the late great MIT.
Yeah, probably did more to that book probably did more to get me into the world of trading than anything else. I love that book.
He did. He was, as a matter of fact, when I was in the doctoral program at Temple University, that was the standard graduate text in international economics.
Mm-hmm.
And I had an opportunity to get to know Kendall Berger a little bit. And then I gave a paper in 1981 at a conference entitled Reaganomics and Stagflation, and I was on the Monetary and Fiscal Affairs panel, and I actually heard the late Hyman Minsky give his financial instability hypothesis.
Wow. Well,
it also overlays, and then of course we have Irving Fisher's great work, the 34 paper on the debt deflation causes of the Great Depression, and there's evidence out there, and I like your terminology, Ira. What we want to do is presume that it's not relevant because it's old. Well, that's not right. In my view, as someone that was trained in econometrics and spent 20 years building econometric models, you have to be able to estimate models over the entire sample period. You try to estimate it over short sample periods, your estimators are going to be off. If a theory is solid, it's got to be explained. It's got to work in explaining events, regardless of whether you have a central bank or don't, whether you have an income tax or don't, or whether you're on the gold standard or floating currency or whatever institutional or idiosyncratic factors. And by assuming that somehow the world changed in the last 20 or 30 years is a terrible mistake that a lot of investors make.
Well, it's been a great insight, gentlemen, discussion. We're just coming up to the end of our time. And thank you very much, Dr. Hunt and Ira, for your insights.
Pleasure. Nice being on with you, Ira.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.